G'day guys, welcome to episode 2 of our new How to Make Money Online series, where we chat to experts outside of the sports betting arena who specialize in other forms of investment and ways to make money online, similar to what we do at Trademate Sports with sports betting. Today, Marius and I are moving from cryptocurrency to options trading as we welcome on Chris from Projectoption. Welcome, Chris.
Thanks for having me.
No, it's great to have you on, mate. And just like I did with the first episode we did a couple of weeks ago, I'll quickly state that my knowledge of options trading is very, very limited, and I'm sure you'll be able to guess that pretty quickly by some of the questions that we've got lined up for you today. I'm not sure what Marius's level of knowledge is like, but yes, it's very, very low. We're coming from a very low barrier over here. But yeah, maybe you just want to give a really brief explanation out there for people who have never heard of options trading before, exactly what it is for beginners.
Yeah, so it's a big arena, and it's a very complex topic, options trading overall. But in the simplest way that I can explain it, options trading is kind of an extension of stock trading. So when you're trading stocks, you basically have two options. You can either buy the stock and you make money if it goes up, or you can short the stock, which means you essentially sell it first, and then you can make money if the stock price goes down. And then basically with that strategy, you would buy back the shares at a lower price, ideally, and then you basically sell high, buy low. Or if you do the opposite, which is the more traditional approach, you buy low and hopefully sell higher. So options trading is kind of the same thing, but there's way more ways that you can make money with options trading. And the big draw for options trading is that you are essentially betting on specific stock price movements, but you're not trading the stock. You're not trading the shares of stock themselves. You are trading derivatives called options, which derive their values from the stock price relative to that option's strike price, as we call it. So to give you a really quick example, let's say we have Apple trading for $150 per share. And I buy a 60-day call option with a strike price of $150. Basically what I'm buying a contract that allows me to purchase Apple stock at $150 per share. And if Apple shoots higher to, let's say, $170 per share, then I have this contract in my possession that allows me to buy shares at $150, where Apple is now at $170. And so that contract has a lot of value. But basically, people trade options in a way that gives them leverage. So compared to simply buying shares of Apple at $150 versus buying that call option that I just described, you would have to put up a lot less money to buy that option as compared to 100 shares of Apple. And so people really come into the options arena because they want leverage or the ability to make a lot of money from a little bit of money. So the last thing I'll say is, let's say I buy 100 shares of Apple at 150 and it goes up to 180, then I'll be up 20% on my money. Whereas if I bought that 150 call option in Apple and the same exact stock price happened, it goes up to 180, my gain on that option position could be hundreds of percentage points as opposed to just 20% on the shares. So just aside from making money from a directional standpoint, you could also use options to protect a portfolio. So if you own shares of Apple, let's say Apple shares go way up since your purchase price and you want to protect against losses, what you could do is you could use the second type of option called a put option, and you could buy a put option against Apple. And since you already own the 100 shares, if you buy this put option, basically it's the opposite of the call that I described earlier. If you buy a put option, it gives you the right to sell 100 shares of stock at the put's strike price. And so basically if Apple shares go to zero, you will essentially lose your stock position, but then you'll have that option position that gives you the right to sell your shares at whatever strike price you had. And so basically it protects your position. So to give you some numbers around that, let's say I buy Apple at $100 a share, it goes up to $200 a share. and then I buy a put option with a strike price of 150 and Apple goes to zero, well, basically I don't lose the whole position. I basically have locked in my gains to 150. So if Apple goes to zero and I own that 150 put option, then that serves as protection. So I can sell 100 shares of Apple at $150 per share versus the current share price of $0. So there's lots of different ways that you can use options. And I've only described two of the basic applications, which is basically speculating on an increase in the stock price and protecting against losses on a position that you already have. So those are just two of the many ways that you can make money with options.
Yeah. One of the follow-up questions I have with regards to that is because you talked about traders using this to leverage their position. So will their risk be limited to the money that they are paying for the options? Or yes, can they have risk beyond that?
So if we're talking about strictly buying options, so you're either buying a call option, which is a position that benefits when the stock price goes up, or if you are buying a put option, which benefits as the stock price goes down. If you are doing one of those two trades, which is just buying a call or buying a put, your risk is limited to whatever you pay for that option. So let's say, getting back to Apple, if I buy a call option with a strike price of $150, and let's say I pay $500 for that option, if Apple goes to zero or is simply just below 150 when that option expires, then I will only lose the $500 that I put into that option. If we compare that to me buying 100 shares of stock at $150 a share, my risk is $15,000 on that position. Since if I lose $150 per share, if basically Apple goes to zero, times 100 shares, that would be a $15,000 loss versus a $500 loss in the option example. So if you're just buying an option, your risk is limited to whatever you pay for that contract.
All right.
So that's another big benefit of using options, is that you can make leverage plays. So you make way more money if you are right about a specific stock price movement occurring. But then you also have limited downside because you can only lose the amount of money that you put into that position if you're buying an option.
Okay.
All right.
Overall, do you think this is quite do most people get involved in stocks first, or do they get into options trading first? Because it seems like quite a advanced, I guess, if you're doing it from the status that you're doing it, it would take a long time to learn these techniques.
Yeah, exactly. So I started in 2013. That was the beginning of my options trading journey, and frankly, my stock market journey as well. And I kind of learned the two side by side, but you can learn stocks. You can learn about stock trading and how the stock market works. You can knock that out, in a couple of days conceptually, but then you can really learn the more advanced mechanics of, how the stock market sort of behaves relative to news and monetary policy and stuff like that. You can learn that over months and a couple of years, depending on how complicated we're getting in terms of, what you're watching in regards to the stock market. But when it comes to options, there are so many moving parts, namely that options are decaying assets, meaning that all else being equal, an option's value will decrease over time as it reaches its expiration date. And then, as I just said, we have things such as an expiration date. We have something called a strike price. There's something called implied volatility, which is essentially how expensive options are relative to the stock price. Generally speaking, more volatile stocks will have more expensive options because since the stock price is moving around a lot more, there's greater potential reward for owning an option on that more volatile stock as compared to owning an option on, a really well-known stock, huge company such as Coca-Cola that has a much less volatile stock price. So implied volatility is an advanced concept that basically just describes how expensive or cheap a stock's options are. So I would definitely recommend getting really comfortable with stock trading first and understanding the mechanics of how you make money when you buy stocks, how you make money when you short stocks, how shorting stocks works, and just getting comfortable with general stock investing first. Because as I said earlier, options trading really is an extension of stock trading, because option prices derive their value from changes in stock prices. That's why they're called derivatives.
So because the options have expiry dates, is it common to buy options with expiry dates like years in the future? Or is it more common to use options trading for more short-term plays?
So that's one of the big questions that a lot of beginner options traders have, because there's so many different things that you can choose from when you're trading options. You can choose the expiration date anywhere from, a few hours from now, so expiring today, or maybe a couple days from now, up to 2.5 years out in time. And then you have all the different strike prices that you can choose from, and all of these different choices that you can make in regards to which option specifically that you trade that will change your potential risk and payoff, so to speak. So a lot of people, when they trade much shorter term options, you pay a lot less for those options because there's simply not enough time, not as much time for a big stock price movement to occur over a multi-hour or a multi-day period as compared to a multi-week, multi-month, or multi-year period. So these shorter term options are going to be a lot less expensive. But if you do happen to buy a super short term option and a massive stock price movement occurs, then your reward or your profit from that shorter term trade is going to be exponentially higher than if you did that same exact trade or you bought that same option just with way more time, because those longer term options will be much more expensive because you're making a less specific prediction. So it really depends. I personally, if I'm going to trade options, it's generally 30 to 60 days out in time on the shortest time frame. But over the past year, I have actually been buying call options on specific stocks that have just been favorites of the market, that, any positive news comes out, they have these massive upside movements. And I've been going out 2 years in time and buying call options on these companies because I don't necessarily want to make such a short-term specific trade. Because I think when you get into options trading, the shorter term you go, I think the more it is like gambling, because there's just not enough time, and you really need to be right about your prediction if you're going to make a very short-term trade. Whereas if you do something that has 6 months to a year before it expires, you have a lot more time for your thesis to play out.
That makes sense. So you touched upon shorting earlier, and I guess everyone who's interested in money has seen the movie The Big Short. Is buying a put option then the same as shorting, or are they different concepts?
So that's a good question. So as I mentioned earlier, there's two types of options, or two primary types of options that you'll trade. One is a call option, and a call option, if you buy it, it gives you the right and the ability to buy 100 shares of stock per contract at the strike price that you choose. And so that contract gets more valuable as the stock price increases, particularly over that strike price. So as I said earlier, if you have a call option on Apple with a strike price of 150 and Apple goes from 150 to 200, that call option is going to get way more valuable, because now Apple's at 200, but you still own this contract that allows you to buy 100 shares at $150, which is $50 below the current share price. Put options work the complete opposite. If you buy a put option, that gives you the right or the ability to sell or short 100 shares of stock at that put strike price. So if we're looking at something like SPY, which is the S&P 500 ETF, super popular product for options traders to use. If you buy a put option on SPY, as SPY goes down, the put option value will increase. So if you don't have any existing position in SPY, meaning you don't have any shares and you just want to speculate on the market falling, one way that you could do that to your advantage is you could buy put options on SPY. And as the market falls, that put option position will become more valuable. So when you talk about the Big Short, they actually weren't trading put options on the market. They were actually buying an instrument called a credit default swap, which is essentially a put option on these mortgages. So by purchasing credit default swaps, they actually are betting against those debt instruments being repaid. And if people default on those loans, meaning they can't pay them, then their credit default swap value goes up immensely. And so that's the specific trade that Michael Burry in the Big Short was making. But it's basically a put option on debt instruments. It's just called a different name.
All right. That makes sense. Let me just think what I have next.
Did you start with Did you start with the stock market, or did you, like, how did you get into options trading? Did you start with the stock, like working on the stock market, and then moved over to options, or like how long did that process take?
It's a good question. So my finance journey really started in 2013, and at this point I was a sophomore. I think I just graduated, or I just finished my sophomore year in college. And prior to that, I was actually in computer science because I love computers. I had a brief history in computer programming, and that stuff always fascinated me. So my first year in college, I actually was in computer science. But then I had this epiphany somewhat overnight. I don't know what happened, but I just woke up one day and was like, I need to learn about managing money. I need to learn how money works. And so I started researching the stock market. I changed my major to finance, switched to a different school. And it started by reading stock market related books. So I read a couple of Jim Cramer's early books. I read Peter, I forget his last name, famed mutual fund manager, Peter Lynch. I read a bunch of his books, and those are all focused on stock market investing. And I was reading online, researching articles, and eventually, if you read enough stock market or stock investing articles, somebody will mention options. And I went down the options rabbit hole, and then I started learning about options. And what drew me in was what I described earlier, was that concept of leverage. So being able to make a lot of money from a little bit of money, definitely way less money than you would actually need to have those same returns if you were actually buying shares of stock. And so I went down the options rabbit hole, started learning as much as I could about those, probably spent a few months reading different options articles before I actually opened up an account of my own. And then I found Tasty Trade on YouTube, which was pretty much the only YouTube channel at the time that was doing options focused content. So I started devouring their content, and then I started emailing the co-founder of Tasty Trade, whose name is Tom Sosnoff, and we went back and forth. And I just happened to kind of stumble into an internship at Tasty Trade because I had asked him about internships in the finance industry with a focus on options. And he had mentioned that they had 2 interns that were leaving right around the same time where I was arriving to Chicago to start going to school there. And so I got an internship at Tasty Trade, and it became my full-time job to learn about options and create presentations teaching other people about options for the different shows or segments that they were doing on their network. And so that's how I got into it. And I stayed there for 3 years, and then eventually just kind of developed my own philosophy, and I wanted to try to do something on my own. And so I left Tasty Trade in 2016 and started Project Option, which initially started as just a blog where I was writing about options. And then I started to make YouTube videos to complement the written stuff. And now I'm focused mostly on the YouTube channel because that's where the growth has happened. So yeah, I definitely recommend that people start with stocks, as I mentioned earlier, because options are much more complex. And if you have a pretty solid understanding of the stock market and how stocks work, then you can start learning about options as they are an extension of stocks.
So just picking stocks itself can be pretty difficult. Have you been using options if, let's say, you have a situation where you have, so for example, within medical tech now, there are 3 companies that have like the patent rights for the CRISPR technique for DNA editing.
Yeah.
So have you bought options into different companies because you were not sure which one of them is going to be the winner? So instead of investing into all of them, which would require a lot of capital, you then instead bought options in different ones in order to be able to benefit from the one that grows the most.
Yeah, that's certainly a strategy. I can't say that I've implemented that strategy specifically where I had multiple companies that were fighting for the same thing. And then I did basically the same play on all 3 of them, or however many there are. But I think that's kind of a similar thing that happened with the vaccine companies, is that people knew that there were a handful of companies that were likely to succeed in being the first to come out with a successful vaccine. And so everybody knew that these companies were the companies that could potentially come out with the vaccine. And so basically everyone was using options to speculate on these companies. And as I mentioned earlier, on companies that have an expectation of having potentially huge movements, the option prices get really expensive on those companies. And so what I would say is if you're looking at multiple companies and you're going to buy options on multiple companies and you're only expecting one of them to win, what you're actually doing is you're kind of increasing the required movement before you can break even. So for example, if you have 3 companies that you think are going to explode higher because they are going to succeed in XYZ or this gene editing technology that you're mentioning, if you put $1,000 into 3 of them, meaning a total investment of $3,000, then basically when one of them succeeds, you probably can expect the other 2 to fall, which means on 2 of the 3, you're going to lose your 1,000. So you're going to lose 2,000 on the ones that didn't make it. And so basically you're going to need to make at least $2,000 on the one that succeeds to make that a worthwhile strategy. Whereas if you were just really convinced that one of those companies was going to make it, if you put in just $1,000 into that specific company and you're right, then if your position goes from $1,000 to $2,000, then you have a $1,000 profit. But of course you have to be, that's a more specific prediction. So when it comes to options trading, the more specific your prediction, the better your payoff is going to be. And it's probably the same thing in daily fantasy sports. Like if you only put money into one lineup and you know that lineup is going to win, well, then you don't have to spend a bunch of money on the other lineups, and therefore your return will be a lot higher. But your likelihood of making money is higher if you purchase way more lineups, but you know that most of those lineups are going to be worthless in the end. But it's a more conservative approach. So that's kind of drawing a comparison between the 2 fields. But I definitely think that using a similar option strategy on multiple companies that you think are fighting for the same thing is certainly an approach. But much like daily fantasy sports, the more money you put into different bets, the higher your return needs to be in the one that eventually makes money.
Yeah, I find that very interesting because that was something that I had thought about maybe doing, but I hadn't thought about the aspect of that needing a higher ROI in order to be profitable there. So yeah.
Right. I mean, at the end of the day, like in daily fantasy sports, you could buy all of the potential lineups, but you probably won't be profitable because you'll have spent so much money on losing lineups where your return on that winning lineup, maybe it doesn't make up for all the money you spent on the other losers that you had because you covered your bases too much.
Yeah. I think you said towards the start of this conversation that one of the things that drew you into options trading was that you could make big returns with little capital. Correct me if I'm wrong on what you said. Does that mean, I mean, normally when people say something like that, it normally means that maybe you have to wait longer periods of time for a big profit possibly? Would that be the case?
Yeah, I think when you're talking about, anytime you're talking about a home run type of return,
yeah,
probabilistically speaking, the probability is low. So in options trading, and we can tie this into DFS as well. In options trading, if you put on a trade that has a 10-to-1 risk reward profile, so if you lose 1x, but if you win, you make 10x, just based on that risk and reward, we know that that trade has a low probability of making money. But if you have a 1-to-1 risk reward, meaning if you lose, you make 1x, and if you win, you make 1x, that's a coin toss. That's a 50-50 bet, right? And so basically there's always a relationship between your risk and reward and the probability of success for that particular position. And so in options trading, I hate to say, like, at the end of the day, you have to be right about a prediction that you make. And obviously you can't be right 100% of the time. You just have to be confident that whatever strategy you have, you will have more wins than losses in the end. And so a lot of people, when it comes to options trading, there's kind of two camps. There's one camp that loves buying options because you have limited risk and you have insane reward potential if you're right about whatever bets you're making. But most of those trades are going to lose money just by the nature of you need something very specific to happen. You're making a specific bet, and that's why your risk is much lower than your reward. Anytime your risk is lower than your potential reward, technically it's a low probability strategy. But then in options trading, there's a second camp that favors high probability trading, is what it's called. And these people essentially are making less specific bets, and they're making higher probability bets by actually taking more risk than their profit potential would be. So earlier I said there's tons of ways to make money with options trading. One of those ways is by shorting options. So instead of buying them and trying to see a price increase in those options, you can actually short the options, meaning you sell them first, and you're essentially betting that the option prices will decrease. So let's say, to give you an example, let's say Apple's at 150 and I sell or short the 125 put. Basically what I'm saying is I think the 125 put will be worthless when the expiration arrives. And that will occur as long as Apple is above 125 when that option expires. So if I short that put option for $500 and in 60 days or whatever, that put option's expiration date arrives and Apple is above $125, then I will essentially make $500 because that put option will expire worthless or be worth $0. So if I short it for $500 and at expiration it's worth $0, I make $500 on that. And based on Apple being at 150, it just has to be above 125 at expiration. And that's a high probability bet because Apple could go to 145, it could go to 140, it could go to 130, and I can still make money in all of those scenarios. And so based on me being able to make money in a majority of scenarios or a high probability of scenarios, I have more risk than my reward. So in that case, my reward potential would be capped at 500. But if Apple went to 0, then that put option would be worth $12,500. And if I short it for $500 and it goes to $12,500, then my loss on that position would be $12,000. So essentially I was risking $12,000 for a potential reward of $500. And based on that risk to reward relationship, that's a high probability trade. So really there's two camps in options trading. One is the low probability approach, which is, making a lot of money from a little bit of money and having that limited risk, which is particularly buying options. And then there's the high probability approach, which is shorting options, in which case you actually have a ton of risk and limited profit potential.
Yeah, I think it's quite similar to sports betting with odds ranges, because some people are very hesitant to be betting on, let's just say, something that's at 15, 20 in odds, 10 in odds, because they can't handle the variance, and that, you still might be finding value there, but I can't really handle the big swings in my bankroll. And, there's people that would prefer to bet on something like 1.5 or 1.3 and stuff like that. It's probably vice versa too. Like, do you think, you mentioned that people are kind of in two camps. Do you think people can be really good at both of those, I guess, strategies? Or do you think it's most of the time like people just have to be really good at one thing? Sorry, I've just lost myself. I'm still here, but
no, you're good. That's a good question. So personally, I like to be really open-minded, and I personally, when it comes to options trading, I can see merit in both camps, but I'm open-minded where I don't, talk negatively about one of the camps. I think in options trading, people somewhat have a tendency, at least from what I've seen, people have a tendency to favor the higher probability camp because you make money more often than not. But the problem I have with that is, like we just discussed, all you need is that one huge loss to wipe out tons of profitable trades. And for me right now, I'm actually more focused on the lower probability camp, such as putting money into something and I can only lose that small amount of money, but I can have, 2x, 3x, 4x, 5x returns on that small amount of money. And then also what's cool about options trading, and something I've talked about in recent videos, is you can make adjustments to profitable positions, and you can basically guarantee that you don't lose any money from your initial outlay. And in some cases, you can even guarantee that you make money. I think it'd probably be too complex to cover in this discussion specifically how that works. But essentially, in options trading, there's something called a spread. So you can buy an option and then you can short an option as kind of one overall position. And the way I've done this in recent history is I start with that risky position where I just make that specific bet about, stock price going up primarily. And then once that position is super profitable, I'm actually able to short another option that actually collects more money than I initially paid for that first option. And this creates a scenario where I basically have collected money into my account for putting on a risky position. And if both of these options go out worthless, since I actually collected money on those two transactions by getting into that position in two separate trades, then I actually guarantee a scenario where I make money as opposed to lose money. So I think in the sports betting world, I think that would be synonymous to you place your initial bet at a specific odds, and then as it starts becoming a higher probability bet, you take the opposite bet at those higher odds. And so by doing that, you could create a situation where you can't lose money. But that's not my realm, so I can't speak specifically to how that would work. But I think that's the idea of it.
Yeah, no, I think that's a good analogy. And in general, like options trading is a lot more similar to sports betting than just investing in the stock market, because essentially when you place a bet on a team, you have a fixed expiry date, which is at the time the game finishes, and then you either win or you lose. And you also have the options to exit your position usually at the bookmakers. You can like cash out. Then the spread that you have to overcome then is usually pretty high. So in general, we favor just sticking to what you initially bet on, and we're just waiting for the game to finish. But yeah, it's similar, and you can also short teams. You can lay them at the exchanges, so that would be similar to a put option. So yeah, there are definitely similarities here.
Yeah, no, for sure. That's one interesting thing is if you have a really good understanding of sports betting or daily fantasy sports, then your mind is already ready to go into options trading and pick it up really quickly. And vice versa, I think if you have a really solid understanding of options trading, then you can go into sports betting and everything makes sense much quicker than if you were coming into either of those fields with no prior experience. And that's how I'm able to, I don't do a lot of sports betting, but that's how I'm able to somewhat talk about it without having that experience, because I know that they're very similar. Like if you pick the favorite every time in a sports bet, then your reward is going to be less than what you're risking, right? Whereas if you always take the underdog, you technically have a lower than 50-50 bet based on where the money is and what the odds are. And therefore, if you take the underdog and you win, your reward is going to be more than what you risked. And then the more specific you get, like if I think the Golden State Warriors are going to score 98 points in a game, then that's a super specific bet, which has a very, very low probability of actually paying out. But if I'm right on that bet, then I'm going to make 10x, 100x, 1000x of what my risk was, since that was such a specific low probability bet. So there's definitely tons of overlap in these two fields, which is why it's very cool to have a conversation with you guys and kind of draw the parallels.
Mentality wise, how do you deal with all of this, mate? Because I know that like sports bettors can really struggle to wait long periods if they're betting on, I guess, a low probability kind of strategy. Yeah, there might be value there, but you still have to maybe wait weeks, months before you get that big payout. Like how do you deal with that kind of mentality side of things?
That's a really good point. And I think from personal experience, I think you just learn it over time. I think patience and discipline, those are two things that are extremely important in options trading and fantasy sports as well, or sports betting, because you can't place so much emotional weight into something working out for you when, especially if we're talking about lower probability bets where probabilistically speaking, it's not going to work out for you. So you really have to just go into it with that mindset. And I think it is learned over time, where you get more disciplined and you realize that the more disciplined you are, the better your outcomes are, at least hopefully. Then over time you can slip into that mindset. Because I know definitely when I started options trading at first, I was much less selective with the positions I took, and I was just forcing positions, and I was taking every trade that I looked at because I just wanted to be in it. But now I have developed the ability to look at lots of different trades and say no to most of them. So I think it's something that you learn over time, and it is extremely important to recognize it and learn it over time, because like you said, you can't put all your stock into one thing working out for you.
Yeah, no, patience and mindset are definitely very important for us as well. So it's good to hear it's the same in options trading as well. You mentioned some of the benefits of doing options trading, being that you can make good money with relatively a small amount of money, and that you also have the possibility to lock in your profits. Are there other benefits, and what are some of the cons of doing, or risks of doing options trading?
So I think from my experience and from interacting with so many people, thousands of traders through emails and YouTube comments over the years, I think one of the risks is that since options are by nature pretty complex, people try to overcomplicate things. Like for me, my favorite option strategies are simply buying calls or buying puts, which is a very simple directional bet in a specific amount of time. And your numbers based on how much you pay for that option and what your prediction for that stock is. Or you could, trade a spread, which basically is similar to buying an option outright, but you're spreading it off. So you're kind of reducing your risk, but you're also reducing your potential reward. So it becomes a more conservative play. And those four strategies, or I guess there's technically four different spreads. You can buy or sell a call spread. You can buy or sell a put spread. Those are four different strategies. And then if we're talking about just the simplest plays, which are buying calls and buying puts, I think those are the most common strategies and the ones that I use the most. But I think with options trading, one thing that people tend to do is they overcomplicate things. So they could do that by trying to trade two things against each other. Like, oh, I think the NASDAQ is going to go up, but maybe the S&P 500 is going to go down. And so I'm going to put two different option plays on both of these things and hope that my prediction is right. Or they just trade really, really complex strategies that have, 8 different components into one position, when more often than not, you can simplify that into a cleaner position using less components. And so I think that's one of the main things that people tend to do, is just overcomplicating things, whether from a prediction standpoint or the number of components that they're using, or even using options when, a stock or just buying stock is a perfect play. Like for me, options don't make up 100% of my portfolio. They only do when I have a specific idea or conviction about a particular outcome. But if I like a company, but I don't necessarily think it's going to explode within the next year or a few months, but I still want to have exposure to it, then I'll just buy the shares. It's a very simple way to get involved. And I don't need to use options just because I know about options and they're there. And so I'd say that's one of the big ideas that has been a revelation to me, is just not overcomplicating things. And then kind of tying into what I just said is, when people get into options trading, there is this idea of leverage where you can make a lot of money from a little bit of money. And when people start learning about options, they kind of forget entirely about traditional investment approaches, such as buying shares in a company and holding it for the long term. And I disagree with that, because when you're trading options, you don't have ownership in anything. You're making a speculative bet on a particular outcome. And I think that's fine with a small portion of your money, depending on how, what strategies you're using and what type of account you're trading. But I think, actually having ownership in something, when we're talking about making money over the long term, I think you can't forget about that. So like personally, I'm a big Bitcoin investor, got into it a lot early last year, just because the economic narrative was starting to play out perfectly for it. And I was like, this is a really big thing. I want to have some skin in the game with this. But at the same time, I understand it's a high risk investment. But had I not taken that risk, then I wouldn't have the gains that I do now. They're unrealized, so they're not realized quite yet. So there's still a lot of risk. But like if I had completely forgotten about actually buying things and taking ownership in things with a long-term mindset, and I was just focused on options, then I would have missed out on that opportunity. And so I think, to summarize, the big ideas or the big risks I see are people just overcomplicating things, making things more complex than they need to be, and kind of forgetting about the overall picture and focusing a little bit too much on options trading, which is much more short-term focused, and you need to be making much more specific predictions to make money doing it.
So as far as I know, it's also possible to buy options in cryptocurrency now. So have you also been buying options on Bitcoin and other coins, or have you just been sticking to options trading in the stock market?
So I haven't been buying options on cryptocurrencies specifically, because I trade with Tastyworks, and most brokerage firms at this point, they don't offer options on cryptocurrencies. So you have to actually open up an account with a different platform that allows trading options on the cryptocurrencies. However, one of my positions currently, which is an option position, is in MicroStrategy. So I don't know if you are familiar with what's going on in the Bitcoin space right now, but MicroStrategy is this tech company, and they were the first company to come out and openly state that they had put all of the cash on their balance sheet into Bitcoin. And the CEO, Michael Saylor, he's one of the biggest Bitcoin bulls out there. And basically all of the cash that comes into their business, they're converting it into Bitcoin. And at this point, they own a couple $1 billion worth of Bitcoin, and their company value overall is only a few $1 billion. So MicroStrategy, ticker symbol MSTR, they're essentially a Bitcoin holding company at this time. And so one thing I did a few months ago and have been kind of trading around this position is I did buy call options that were expiring a couple of years out. And I bought call options on MicroStrategy with the assumption that Bitcoin was going to increase. And since they own so much Bitcoin, if Bitcoin goes up, then their company value goes up, and therefore their stock price goes up as well. And that's exactly what we've seen. So if you go take a look at the stock chart of MicroStrategy, MSTR, you'll see that they've had just insane parabolic moves to the upside. And I did take advantage of that and do have open positions in MicroStrategy. And the reason for making that trade was due to Bitcoin. But that's kind of a proxy trade. So I'm not actually buying options on Bitcoin. I'm just buying options on a company that has extreme exposure to Bitcoin. So based on the movements in Bitcoin, that stock price will follow. So I think that's an interesting way. If people have accounts such as retirement accounts where they can't actually buy Bitcoin in those retirement accounts, but they want exposure to Bitcoin, one thing that you can do is you can just buy companies, publicly traded companies that have exposure to Bitcoin. And MicroStrategy is the one that has the most exposure as of now. But another example would be Square, because Square is another company that's come out and they have a lot of Bitcoin on their balance sheet, but just a much smaller percentage relative to what MicroStrategy has. So if someone's in a retirement account and they can't access Bitcoin, but they want exposure to Bitcoin in that particular account, then what they can do, and they could just buy shares of those Bitcoin companies, or they could buy something like GBTC, which is the Grayscale Bitcoin Trust, which all they do is they hold Bitcoin.
I haven't thought about that being a good reason for doing it that way instead of just holding the underlying asset. But yeah. If you have restrictions that don't allow you to get the actual asset, then you can just buy investments that hold that asset. And more often than not, there will be an ETF or some type of publicly traded company or investment vehicle that actually has exposure to that asset that you can buy. So another example would be like if you don't want to buy and hold physical gold, then you could buy a gold ETF such as GLD. But there are some problems associated with that approach. The main one being similar to gold and Bitcoin. There's a saying in the cryptocurrency space, not your keys, not your cryptocurrency, or not your keys, not your Bitcoin. And basically what that means is if you don't have possession of your actual private key that can spend your Bitcoin, and you're not custodying that yourself, and you're basically trusting a third party such as Coinbase or a cryptocurrency exchange to keep that safe, then technically you don't really own it, but you do, you have exposure to it. So similarly with GLD, if you just buy the ETF and you don't have the physical gold in your house, then technically it's a very similar thing where you don't actually have the gold, but technically you have something that has exposure to it. So there are definitely risks with, the different investments, but if you want exposure to something, there's more often than not a publicly traded fund or vehicle that you can actually put money into to get exposure to that asset. All right, so I have two more questions for you before we wrap things up. And you've talked about some of the most common option trading strategies, but I'm sure on your YouTube channel you cover some of the more advanced strategies. So could you just give us like a super quick rundown of what some of the more advanced stuff is and which videos they can watch it on your YouTube channel?
Sure. So I would say probably the most popular complex strategy is called an iron condor. And what this is it's a combination of selling or shorting a call spread and shorting a put spread. So basically, if you can imagine these two, both hands represent one of the spreads. Basically, you make money if the stock price remains in between these two spreads. So as I was talking about earlier, this is a high probability strategy because all you need to happen to make money is the stock price to stay within whatever range is associated with your iron condor's strike prices. And so if you can make money as long as the stock price stays within a wide range of prices, then you have, well, since that's a high probability strategy, then you'll have more risk than profit potential in most cases. So like you could have an iron condor where best case scenario, you make $200, but if things go against you and the stock price either goes up a lot or down a lot, then maybe you could lose $800. So again, lots more risk than reward, but you have a high probability of seeing that position play out for you. So that's probably the most popular complex option strategy would be the short iron condor is what it's called, or selling an iron condor.
All right. And beyond just sort of, because you've covered how to like actually make the options trades, but what sort of information resources, what do you research in order to determine which options that you are going to buy? Are you digging through financial sheets, or what are some of the things that you are looking at?
So I think there's lots of different ways that you can approach it. You could definitely approach it in more of a fundamental analysis type of way, where you're actually looking at companies, you're looking at their balance sheets, you're interested in the actual business. And then from there, you have a specific prediction about what that stock price is going to do based on the company's performance. And then based on that prediction, let's say you think the company is going to do very well and the stock price is going to see big upside movements. Well, then that narrows it down to a handful of different option strategies. And once you have your prediction, then you have to kind of decide what type of risk to reward do I want, or what kind of exposure do I want to this? So for example, if I think a company such as Tesla is one of those stocks where everyone's trading it. It's one of the most popular options trading vehicles out there. And there's two camps. There's people that are diehard believers in Tesla over the next few years. And you have a company like ARK Invest who has these insanely bullish calls for Tesla's share price. And so if you buy into those philosophies or their predictions, and you want a lot of reward potential and a limited amount of risk, well, basically that would mean that you are going to buy a call option on that stock. Or maybe you buy a super, super wide call spread that is out of the money, which basically means like you need the stock price to move really favorably. Otherwise, you're going to lose money over time. And then once you narrow it down to those handful of strategies that fit your specific prediction, then you basically have to choose a time frame. So for me, I like to go longer term with these, simple option purchases like buying call options on a company like Tesla. If I think it's going to explode, then I'll go really far out in time just to give that thesis time to play out. But I will pay more for that position because it is less specific of a prediction as compared to a shorter term trade. And then once I know that I want to go further out in time, then basically I can look at all the different strike prices and see how much it will cost and kind of just make a decision based on how much I'm willing to spend on that position. But there's the tricky thing with options, and one thing that gets people hung up is that there's, as I said before, there's so many different expirations to choose from. There's so many different strike prices to choose from. But at the end of the day, there isn't one specific right or wrong answer. You just kind of have to understand the differences between, a shorter term position and a longer term position, and how that will affect how much you have to pay to get into it, or, your risk to reward profile if you choose different strike prices or expirations. So that would be a more fundamental analysis approach. But then there are people who do technical analysis, and I'm not one of those people. But basically, if you have a technical indicator you're watching, or you're looking at support and resistance levels, then you would wait for the stock price to get to one of those levels, and then you would enter your option position. Or you could even structure the trade where you make money as long as a stock doesn't violate a support or resistance level. So, as we've kind of learned throughout this whole discussion, options trading is a super complex field, and you can get very specific with how you want to make money. But that's another reason that it's a powerful tool as opposed to simply buying or shorting shares of stock, because with either one of those, you just have to buy the stock and make money if it goes up. or short the shares and make money if it goes down. But with options, you can make money if a stock stays range bound. You can make money if a stock price goes up. You can make money if a stock price goes down. Or you can make money if a stock price makes a big move in either direction. Or you can make money if the stock price doesn't do anything and kind of sits right where it is, and you just make money from those options losing value over time. So there's lots of ways to get way more specific with your predictions when trading options, as compared to simply buying or shorting shares of stock.
Awesome, mate. I hope you've enjoyed going through the very basic concepts of options trading today. I hope there's been a little bit out there for everyone. So, you know, people that are just beginning or never really heard of it before have got, I'm sure they've got something out of this. But yeah, also the people that have spent a bit of time with it too, mate. I guess I implore people to go and check out your YouTube channel, where I'm sure people can, because we've only got a limited amount of time, or we can ask you questions. So yeah, I assume that you can answer a lot more questions on your YouTube channel. Is that the best place for people to go and find your work, mate?
Yep, that would be greatly appreciated. So yeah, the YouTube channel, as listed below, is just Project Option, one word. You just search that into YouTube, you'll find me. So that would be the best place to reach me.
Awesome, mate.
There's tons of content on there for beginners. Actually, my most successful video I did last year, and it's options trading for beginners. It's a 3-hour crash course, so to speak, but it's been super valuable for a lot of people, based on how successful, how many views the video's gotten, and all the comments that people have left on it. So if you're looking to learn more about options trading, and especially if you're a complete beginner, that would be a logical place to start, and love for you to come check out the videos.
So what you're saying is it only takes 3 hours to get over the beginner hump.
Yeah, I think in 3 hours you can make a big leap in your understanding. But I've been involved in the stock market and looking at options and trading options, and I've just had a lot of experience over the past 8 years. So basically full time for 8 years, I've been involved in this space. So it definitely takes time and a lot of different trades and iterations of, you know, getting into trades and seeing how they perform relative to changes in the stock price and changes in time and whatnot, to actually get a really solid grasp of how this thing works. But you can definitely learn a lot about the theory in a lot of the videos that are out there and on my YouTube channel as well.
Yeah, no, it's been awesome having you on, mate. Thank you so much for your time. And yeah, like I said before, I hope everyone's been able to get a little bit of knowledge out of this conversation. But yeah, thank you so much, mate. And yeah, we'll have to catch up soon, maybe when Marius and I have improved our options trading knowledge a little bit more.
Yeah, for sure. I'd love to come back on, and thanks for having me.
Awesome. Yeah, guys, if you can comment any questions, and maybe Chris can get to it at some point, and I mean, we can try and answer it too. But yeah, subscribe, do all the good stuff, and yeah, thanks for watching.